Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US credit and global market engagement at Informa Global Markets. I'm here with my colleague and co host, Bruce Clark.
Morning, Shanks.
Hey, morning, Bruce. He's the head of rates market coverage at IGM. So today we will be talking about financial covenants in debt instruments. The strict definition of covenants are legally binding conditions that require a borrower to maintain specific performance metrics, failing to maintain which could trigger early repayments or even a declaration of default. They are, in short, important guardrails for investors and lenders. But over the years, as the hunger for the higher coupons on debt, higher yields on debt, with low default rates, more confidence in the ability of companies to pay interest and competition has led to some deterioration in these important protections. What are financial covenants and why are they important? Are investors missing a trick by not demanding the strictest covenants? How are companies taking advantage of it? We'll be asking answers to these critical questions to Ian Walker.
Hi, Shankar. Hi,
Uh,
Bruce.
Thank you. And he's an MD and head of legal innovation at Covenant Review. Ian joined Covenant Review in 2015 and is an expert in legal covenant analysis. So he is the main guy for understanding this subject. He practiced law at Davis Polk and Wardwell and represented both borrowers and lenders in leverage finance transactions as well as a variety of other financing transactions, such as structured finance and aircraft financings. He's also a subject matter expert on private credit, LIBOR, and SOFR. So thank you very much, Ian, for joining us on this podcast. Thank you.
Thanks for having me.
Thank you very much. So I'll kick it off with a simple question, but a complicated one. What
Mhm.
are financial covenants and why are they so important?
Sure. Before I answer that question, Shankar, let me just take a step back and explain what are covenants, period.
Right, right,
Because it's sort of like it's a little bit of a mystery to most people. So
right,
covenants, right, in a loan agreement or a high yield bond are just an agreement by the issuer or the borrower to do certain things, or it can be a limitation on the borrower's ability to do certain things. Or it can be a requirement that the borrower maintain a particular financial metric. So
right,
you've got three kinds of covenants, right? You've got an affirmative covenant. Affirmative covenant is you agree that you will do these things, such as, for
right,
example, you will deliver your financial statements on a quarterly basis. A negative covenant says you can't do these things. So it says you can't pay dividends, you can't make investments, you can't incur additional debt, except maybe you can do it in these limited circumstances. And then our financial covenant, which is the topic of today,
right,
is a requirement that the borrower or the issuer maintain a certain financial metric. So think of any financial metric you think of, you're going to have a financial covenant for that. So it could be a leverage ratio, it could be a leverage ratio being the ratio of debt to EBITDA,
right.
a coverage ratio, which is a ratio of EBITDA to a interest coverage ratio, interest expense, or fixed charges. It could be a current ratio, which is like assets to liabilities, and on and on. So any financial metric could be made into a
Financial covenant. Right, right. And what is why are they important? Like in what way does it protect lenders or investors?
other extremely important, right? Because it's like the proverbial canary in the
Right,
right. A financial covenant allows a lender to monitor a credit and provide a signal that trouble is ahead, right?
right,
So as you mentioned at the top of the show, the consequence of breach of a financial covenant is serious, right? It could result in the lenders having the benefit of the financial covenant declaring a developed default and accelerating the payment of the loans prior to maturity. But it really doesn't really play out that way in practice, right? There are several
Right.
steps that have to happen before you get to acceleration.
Right.
So in most credit agreements, you've got cure rights. You know, the borrower can cure the default by injecting some equity. And then even if the borrower hasn't cured the financial covenant default, there are still provisions in the credit agreement that require you to get at least a majority of lenders to declare the
Right.
default. So it's an important tool. What actually happens in practice, right, if
Right.
there is actually a financial covenant default, is that the lenders who have the benefit of that covenant will negotiate with the borrower to waive that default, but
Right.
in exchange, the lenders are going to get some concessions. Maybe it's better
So these are almost like
economics.
warning signs at this point, right? Like, so
Exactly.
you kind of know this company is getting into trouble, so let's start working out a solution around it. Is that how it works? Yeah, at this point.
Yes.
Right. And like in terms of history of these covenants, right? Like I talked about it when I in my intro as well,
Mhm.
is how things have kind of they were very tight earlier, or and then they started becoming lighter, and people started talking a lot about covenant light structures.
Mhm.
Is that how it has evolved, and why did it like get from really tight covenants to loosening a bit?
All right, this is the interesting part, right? So, if you really go back in history, like debt covenants started out very simple, right? It's like
Okay.
a promissory note. Um, you agree to, I'm lending you $100 million, and you agree to pay me back $100 million at a certain time, at a certain place, at a certain rate of interest, um, in a certain currency, right?
Right.
That's it. One page. You don't need more than that to
Right.
actually do it. But over time, these agreements got evolved to become much more complex, and to the point that now we have these 500-page, very complicated documents that very
Right.
few people understand.
Right.
Um, I'm still on the learning curve myself, especially with with all of the new technology that's coming out. And when I say technology, I speak in the context of provisions in the market. But on a serious note, though, um, really, let's go back to the RJR Nabisco LBO,
Right.
because that's like a significant watermark in the market, right? So up
Right.
to then, most of the lending in corporate lending was like investment grade, and because these were the money center banks making these loans, and these are the JP Morgans of the world. So it's basically an investment grade market, is corporate lending.
Right.
And RJR Nabisco LBO wasn't the first LBO ever, but it was one of the biggest and sort of very notable. Happened, and the existing bondholders were left with worthless bonds because it was like a huge LBO, all this leverage put on top of RJR,
Right.
and they had nothing, no say, right? Because guess what? That indenture, the thing that we now think of as very sort of standard, which is like a change of control covenant, was not in those indentures, right?
Right.
So that sort of like kicked off the development of change of control covenants so that bondholders get the ability to put their bonds to the issuer if a change of control, if an acquisition happens,
Right.
right? And then, so the way this sort of describes what's happening in the market today, which is that it's very reactive. So any sort of like big headline grabbing event that happens will result in a new provision coming into the market,
Right.
right? And so that's how sort of the market has evolved over time, which is as the investors starting to see that they need more protections than
Right.
what you sort of see in the investment grade market, because this is now a high yield market that's sort of like evolving, becoming more sophisticated, and So over time, we sort of started to see different developments. So let's start with leverage loans, right?
Right.
And financial covenants. So in sort of like, up to around the early 2000s, like before 2002, in a typical leverage loan credit agreement, you would have around up to six financial covenants,
Right.
right? That was like pretty standard. The longer list of what I sort of like talked about before, you could have a leverage ratio covenant, a coverage ratio, a current assets, current ratio, a minimum EBITDA, on and on, right?
Right.
And then around 2003, you sort of like whittled that down to about one to two. They're static, it's just like set at a level, it doesn't step down.
Right.
Lots of headroom between where the covenant is set and
Right.
where the company's leverage is. So the chances of like breaching that financial covenant are pretty low,
Right.
unless there's like some significant leveraging transaction that happens. And then we started to see covenant trickling into the market in leverage notes. And
Right.
covenant is a term of art in the market. What it means is that the loan does not have the benefit of a financial covenant.
Right.
Now, I should step back for a minute because
Right.
I've been talking about this um, loan as if it's like everyone knows what I'm talking about. So
Right.
the market that I'm talking about is for institutional terms,
Right.
right?
Right.
Held by non-bank financial institutions. The banks, the regulated banks, tend to be on what we call the pro rata tranches of those credit agreements, which means the revolver, which is like an undrawn facility,
Right.
but it's committed and can be drawn at any time, and then the drawn pro rata term note. Um, so what we started seeing in the market was that this phenomenon of the institutional term loans
Right.
started to become public. But in that same credit agreement, there is a financial covenant that is for the benefit of the pro rata tranche. Um, so let me pause there. I mean, I have more to talk about the history, but see if you had any questions on
No,
what I
no.
just
So
talked about.
like I think that explains a lot about how the market has evolved as well, right? Like, and I think borrowers got sophisticated, so they also tried to come up with provisions that are beneficial to them, and not just giving away all the protection to investors and giving them all the power. So it's kind of tallies in with how um, the reliance on debt grew over the years, which you mentioned, but at the same time, sophistication among the borrowers to read documents or create provisions that are beneficial to them is what you have been talking about. So that created this kind of tug of war between issuers, borrowers, and lenders, right? So who is coming up with a new provision
Yeah, yeah,
to to outplay the other, which is very interesting. I think it kind of it's part of the evolution of the debt markets. But do you think so? Where does it now? You're saying 500 pages of documentation. Do you think investors have the capacity to parse through 500 pages of documents and then figure out this one loophole in there which might make them lose money on that investment?
well, thanks for the advertisement, Shankar, but actually, I agree. Uh, no, investors do not have the capacity to do that, right? I mean, that's the reason for my existence, right? I mean, it is a pretty treacherous task to go out there and try to read these very, very complex legal documents,
Right.
understand the nuances of the provisions that are being put into these documents. And you have very sophisticated law firms who are drafting these documents, and they are looking for ways to put provisions in these documents that
Right.
are innovative and that allow them to get around what the lenders are trying to achieve, right?
Right.
So it is a very tricky thing. I think it's important to be able to understand what is exactly happening in these documents,
Right.
um, parse out the treacherous provisions, understand why they're problematic, and also sort of like to understand why something might look on the surface to be problematic, but maybe it's not, right?
Right.
So don't
Right.
get put a lot of effort into pushing back on something that's like pretty benign, right?
Right. So you're like, so lawyers are advising both sides and they're creating advantages for both sides. But do you see them, like, are all these covenants which you talked about, right? Like, they're very complicated, and it's great to highlight some of them and the possibility of what um, a company could take advantage of, or minimize your your claim to that loan or that asset. Do you think all of them are worth, like, worrying about? Like, is there some you could say, okay, I trust the borrower, they're a good company, I don't think they will take advantage of this provision, or
Yeah,
the advantage in this business is trust in this business is not a thing.
yeah, no, I think that's right. So absolutely, you're correct. I mean, the things that investors need to worry about are being primed, right?
Right.
So you've got like a position in the capital structure. You don't want to be primed. You don't want to be diluted with respect to your position in the capital structure. That's number
Right.
one. So the debt covenant, liens covenant, those are like number one and two. Then the next thing you don't want to happen is to have value leave the credit, right? And
Right.
by that, I just mean the company needs to have enough assets and cash flow and all of that to be
Right.
able to pay back your debt. So you don't want dividends going up to the sponsor. You don't want the company making investments in software as a service companies.
Right.
That's a dig at software companies, sorry.
Right.
And then you don't want them prepaying other debt in the capital structure that's junior to you. So those are the main focuses of the covenants. I think that
Right.
people, absolute must-haves in every deal.
Right.
Um, Another set of covenants that I think people overlook often is the sort of like the governance
Right.
covenants, right? The affirmative covenants. So the reporting covenants are absolutely vital. If you can't monitor the company's financial performance,
Right.
then all bets are off, right?
Right.
So those are the things that I think are important, necessary in every deal. And the devil's in the details as usual.
Hey, Ian, do you sense any macro trend in these covenants? And other, there's a lot of concern, especially about infrastructure spending, AI data centers, and the hyperscalers, and so on and so forth. Does concern about hey, these guys are borrowing an awful lot of money? Does that find its way into the covenant? I mean, do you see trends in the lenders are becoming, scrutinizing these companies as I don't want to call it a bubble, but as the exuberance sort of grows in those markets, and contrarily, do the borrowers, are they getting increasingly creative? I mean, I guess what I'm trying to say is there a macro trend in all this, whereas the covenants start to tighten before it becomes apparent that there's a problem in a market.
Yeah, Bruce, that's a very, very good question. And the reason it's good is because I actually think it's one of the problems in the market right now, which is that it's a very technical market, right? And by that I mean, I could sit here and talk forever about how bad the documentation is, and the lenders know it, the market knows it,
Right.
but it's still driven by
It's
technicals,
like,
right? There's lots of dry powder on the sidelines. There's lots of
right.
supply. I mean, so lots of demand, but very little supply. So what happens in the market is that all of these like sort of like very problematic provisions that can clear the market if you've got a very good credit.
And as we see, I mean, these these big AI infrastructure deals keep coming to market, but there's just huge demand for them still, right? So
Yes.
it's almost
Yes.
like everybody's going looking.
Yeah, no, it is.
Okay.
It's a history of the leveraged market, very short memory, and it's just the imbalance of supply and demand that drives
Right.
everything that
Right.
happens.
Right. Like,
Um,
like, some in the housing market, the memories of 2008 are long forgotten, right? It's
Right.
like, hey,
no, exactly. And if we had some visuals, it would like be very interesting to look at it because we have data going back to say 2016, for example. So not the GFC, right? But just
right.
like covenant data going back. And when you look at the charts, like the time series charts of any of our data for the BSL market, you can see every single disruption in the market. You can see COVID. You can
Right.
see Ukraine war. You can see, tackle. I mean, like every single sort of like economic disruption is just apparent in these charts. You just see the spike and then they come back down to the mean,
Right.
right?
Right.
Um,
Without naming names, I mean, you as a as a lawyer or the lawyers, are they pressured by either the borrowers or the lenders to, let's say a lender just comes and says, listen, Ian, I just need this done. Write whatever you need to do, but we need to, we need to make this loan happen. I mean, does that exist?
oh yeah, absolutely. So
Okay.
it is a relationship driven market.
Hmm.
More so on the private credit side. Um, and when I talk about relationship, I mean between the lenders and the borrowers. On the private credit side, on the BSL side, the relationships there are between the banks and the sponsors because the banks are the ones that are putting the syndicates together.
Right.
And so there's like not as much connection between the individual lenders in the BSL market and sponsors. So yes, there's a lot going on there in terms of relationships and repeat players,
Right.
and the sponsors have a lot of leverage. And
Right.
again, just a supply and demand question. If you've got dry powder, and what are you going to do? You're going to go to your boss and say, "Well, I didn't invest in
Right.
the greatest deal because the documentation was bad." Meanwhile, you're going to get paid
Yeah. Nobody
your
wants to deliver
expectation is you're
that
going to get
news,
paid
right?
for it. Yeah. So you
Yeah.
may as well, you know, you don't want to sit on the side. This was the pre-G GFC line, right? You don't want to be caught sitting on the sidelines. So I think it's the
Right.
same dynamic here.
Yeah. I mean, I'm sensing that it's not too terribly different from stock analysts. Like, hey,
Mhm.
say something good about the company because they'll use you for the next issue, right?
Yeah, yeah,
Yeah. So there's a commercial angle to the whole thing.
yeah.
But it's actually interestingly talking about the structural changes which the market had to grapple with. I think one of them was this whole rise in liability management transactions, right? Like, there was a lot of these workarounds of companies which were close to declaring a default or couldn't refinance their loan or debt, came up with these structures which were from the pre-crisis era, right? Like some of them were called drop downs and double dips. Could you kind of explain a little bit on why these things happened? I think it's almost like, from my side, it felt like the investors didn't want to write off a loan in their books, right? Like, so they were happy to come up with or help companies stave a default. But
Yeah,
what's your call on all that?
sure. I mean, so it is very interesting. Like liability management transactors are not a new thing. I mean, we just call them a different name
Oh,
back in the day. So it was just
right,
like a simple out of court restructuring, right?
right,
Um, uh, this has always been the case, right? Where you try to preserve value, and sometimes you're like, okay, what's the way to preserve value here? Is it, do we just file for bankruptcy, or do we try to sort of like restructure the balance sheet up court, right?
Right.
The difference that we're seeing in the LMEs today is that it's no longer sort of like everyone playing together and being nice and sort of like ending up with like a restructured balance sheet where everyone sort of like is treated equally. It's the so-called lender on lender or creditor and creditor violence that's happening, right?
Right.
It is where you're now having one group of lenders, sort of like a majority group of lenders, um, priming in some way or form another group, the minority group that didn't sort of like
So priming means increasing the claim above the others. Yeah.
yeah, in different ways, right? So it
Right.
could mean that, like, for example, you're primed by what we call structural subordination, and that's
Right.
what we talk about when you talk about the drop down. It means that you're moving assets outside of the credit, right, to maybe like an unrestricted sub or a non-guarantor. And by virtue of the fact that that's like a non-guarantor, any debt that's issued by that non-guarantor is going to be structurally senior to your debt because you don't have a claim that's
Right.
that person is not guaranteeing your debt. You don't
Right.
have a claim against that other entity's debt. So if you put debt on that, move assets to a non-guarantor, unrestricted subsidiary outside of the credit, you issue debt at that new entity, that new debt is structurally senior to the existing debt that you have.
Wow.
So that's one way. Another way is what we call the up tier transaction, right? That's the
Right.
CERTA, sort of classic CERTA transaction where you put in, so you could have an existing facility, you put in a new sort of like pari passu facility, but then you change your payment priority, right?
Right.
Such that you now, this new facility gets paid before the existing one. So that's called up-tiering, where you've now subordinated the right of the existing lenders to get paid
Right.
um, to the right of the new lenders. And it gets very complicated because then you then have these multi-tranche facilities, right? You
Right.
can have first out, second out, third out, fourth out. I mean, and then the way they structure these transactions is such that sometimes if you agree at the beginning, so if you're in the biggest group that
Right.
control it and you agree at the top that you're going to take this haircut, but you're going to get that first out position, get the best economics, and then so on and so forth.
Like how does it help you? Like if a company is closer to default, right?
Mhm.
In just increasing your priority or improving their chances by that much, by giving them more money, and then ensuring they don't default on that loan, but then they have a new loan. All this complication, how does it help the business if the business is not performing? The
Oh, well,
company is going to be in that same position again,
yeah,
though, right?
yeah. I mean, above my pay grade, Shankar, but the way to think about it is that, like, obviously it's a value preservation
Okay.
question, right? So if you believe that what this company needs is a right-sized balance sheet,
Okay.
right-sized capital structure, so what they try to do is capture discount, right? So that sort of provides some amount of delevering,
Right.
right? And then extend maturities, right? So that they have some runway.
Right.
Um, so that's the theory. And then if it's like a fundamentally good business that's still throwing off cash, it still has cash flow to like service its debt and all of that,
Right.
it's all good. It doesn't always work out, right? Because we
Right.
have seen many instances of either multiple LMEs, so like LME after LME after LME. It's like,
Right.
okay, you're still kicking the can down the road here, or companies where they've done an LME and then eventually they end up in bankruptcy anyway.
Right.
But it is a theory it is a way to preserve the value. It does require a lot of like analysis
How
and
much of the proportion of these kind of distressed exchange, almost like some people call it, ends up being a bankruptcy in the end?
oh
Or, yeah,
I don't have that number off the tip of my head, but
right,
I can
right. But those are like, some of them do end up in
it
this,
happens,
or
right?
unless they do multiple LMEs and keep pushing the ball forward. That
Yes.
is interesting. So that kind of almost brings to the question, what's the point of the covenants? If you're going to notice there is a problem with the company and then come up with a solution which creates new covenants so that you can create have the leeway to survive, right? It's almost like an exercise.
It's
Yeah,
a
no,
it's a living
it's
document.
yes,
Absolutely.
exactly, exactly. No, it is a very good question. I mean, like, so the point of it, I mean, you really want to, so let's go step back for a minute, right? Like, you, so I said, yes, you want to be able to like, it's important to make sure that you don't get prime, you don't get
Yeah,
value leaking from the credit. But these are companies, like you said, living, breathing companies. They're operating on a daily basis, right? So
right,
you don't want to shackle the company and then no, they can't sort of like run their business. They can't be successful because you've said, well,
right,
I'm monitoring every single penny that you're spending, and you can't spend. You've got to come to me for approval before build that new data center, for example.
right,
Um, so there's a balance between um, having a covenant package that sort of like limits what the company can do, and allowing the company to the flexibility to run its business as it
right.
sees. Um, so
So you
that's
need
number
that
one.
balance, basically. It
Yeah,
can't
you
be
do.
one or the other. Yeah,
So yes. So I mean, so no lender is going to want to. You could easily draft a document that says you cannot spend $1 without coming to me. That
right,
doesn't work, right?
right,
Um, so so the covenants. So the question we really need to think about is where do we put the line of flexibility for the company to do its business, and that's where the struggle always is in those negotiations between
right,
the lenders and the borrowers. Um, but I think a good way to think about this, right, is that you know if especially in the liability management area, right? Because like the same idea, you
right,
could easily put a provision in a document that says thou shalt never do a out of court restructure or an
right,
LME. Cannot do it, right?
right,
But that just doesn't work, right? From a lender perspective as
right.
well. You want to have the flexibility um, to do these things.
Renegotiate.
Yeah,
Right,
exactly.
right. And actually, Ian, I wanted to move to another topic which you are an expert on as well,
Mhm.
is about private credit, right? Like, we hear so much, there are so many headlines, warnings about the sector and how things are. From the structural side of it, do you really see cracks in private credit? Is there an issue about a financial contagion from this sector and what's going on there?
Cracks. Like what cracks? I mean, so no, I mean, like, seriously though, I think it is a little bit overblown what we've been hearing in the market about
Right,
private credit being a potential problem. From my perspective, and I'm not speaking to the macro of it at all.
right,
It is a much better market than the PSL market from the perspective of documentation. We've been tracking this for a long time,
right,
um, and there is like a market. These are just completely separate asset classes. Um, there might be some convergence of the upper end of the market. So you've got like these jumbo $1 billion unit tranches, which are considered private credits, like held by very um,
right,
few lenders and so on and so forth. Um, but otherwise, there is a wide gap between private credit and BSL. So the documentation is much better.
Right.
It's a very different dynamic. We haven't seen LMEs in private, and when I say LME, I mean the lender violence type
Right.
LME in private credit yet. Doesn't mean it won't happen, but there
Right.
are many reasons why it hasn't happened yet. It's just a relationship-driven market. The relationship is between those lenders and the sponsors directly. Um, and these are repeat players, and they have a closer relationship with the borrower, right? So they're going to negotiate uh, provisions with the borrower when the borrower is in trouble. So it's like
Right.
not the same dynamic at all that we're seeing in BSL. So I think it's a
BSL
different.
is primarily banks, yeah? It's banks and financial institutions.
Well, yeah, so the BSL market, when I say BSL, I mean broadly syndicated loans. Sorry for using
Yeah.
jargon on the podcast. I
Yeah.
apologize. But broadly syndicated loans are syndicated by banks, right? But the banks don't hold those loans. They syndicate them to non-bank financial
Right.
institutions. Typically, the biggest holders in the broadly syndicated loan market are CLOs, which are just collateralized loan obligations.
Right.
Um, so, so it's a very different market in private credit
Right.
compared to. And the one other thing I'd say on the sort of like the buzz around the cockroaches in private credit is
Right.
that so far all we've seen stories that have been coming out are fraud, right? Or something else that have nothing to do with um, the
Bigger
underlying
institution.
credits. Yeah, it's
Right.
not like a systemic credit issue. It's
Right.
more some kind of fraud, something like that. So I
Correct.
think it's a little bit overblown, to be honest.
Yeah,
Doesn't
that
mean that. Yeah, go ahead.
no, I'm sorry. That's consistent with what we've had other guests on here that have expressed a similar sentiment, and they just said it's like you said. The bad news is mostly fraud, but the upside is that earnings are sufficient to cover interest at a lot of these places, and that the concern about, as you say, cockroaches, never being more than one cockroach has just been overblown. And I think that's been proven out in the last, couple of months here anyway.
But Ian, like, now we are also seeing a lot of reports about, because there is all this issues about private credit, returns haven't been that great. So they don't have the same amount of money that was flowing into them for investments as they do now. So banks are starting to grab some of the market share because banks had were preserving capital earlier because of expectations that regulatory capital will go up. But now they seem to be going back to those companies which they had kind of ignored earlier.
Mhm.
Do you think that means that the BSL market will again go back to old form almost, and covenants will start, loosening on that, where companies have more flexibility because of increased competition? Do you think that's kind of happening, or is there?
Yeah, no, so I think it's very interesting. So the way I think the banks are playing in private credit right now, from what I understand and what I've seen, is
Right.
that they're really just providing leverage to the private
Right.
credit funds, right? So they're not taking direct positions in private credit loans. It's more, they're just providing leverage to the blue walls and blue girls.
Correct. But they're not trying to grab their customers, their clients. They're not.
No, so that's a different phenomenon. What we've been seeing in the market. It's not as common now, but what we've seen historically is that a deal when a sponsor is trying to sort of like do an LBO or whatever, it will go to both private credit and BSL markets and
Right.
ask for proposals. And so you'll see them competing. So the banks will be the ones doing the BSL, will be competing with the private credit
Okay.
market to get these mandates. Um, but and then so it actually is interesting because like that's what has driven a little bit of the convergence between the two markets, especially on the upper side. which is that the private credit lender needs to then sort of like work on what's the proposal that will get them the deal. Do they have to like decrease their traditionally higher margin that they get? Do they have to offer better terms to the borrower to get that deal? And then, same thing on the BSL side as well, right?
Right. So the competition is creating some choice. Yeah. I think it
Correct.
had gone the other way a little bit when private credit was your only solution, but now you think both sides are coming in.
Yeah, it's been
Right.
going back and forth
Right.
historically. So
Right. And like this is a question I always comes to my mind. So you can't correlate between looser covenants and credit markets being complacent, right? Like is there like if there are looser covenants or there are lots of covenant-lite loans, do you think that that's a market which is being complacent or
yeah, well, yeah, I mean, like in a sense, right?
right,
Because like we've discussed before, uh, people have short memories, right? But I probably wouldn't use that word complacent. I'd
right,
probably use a different way to talk about it. I just think it's more that the there's a risk matrix, there's a decision matrix that you have to
right,
use to like make an investment, right? Um, right now, documentation standards is not at the top of that decision matrix.
right,
And I think it's unfortunate. I think we really would be all better off if documentation risk was more heavily weighted in
right,
that decision matrix, because it would result in better documentation overall for the overall market, so that because if you think about it, if
right,
you like a credit, why do you care that the documentation sucks? Because you don't think that credit is going to default, right?
right,
So it doesn't really matter. It really matters though on the lower end of the spectrum, where it's like a more shaky credit and the chances of default, and you're needing to um, rely on provisions in the document for
right,
protections is higher. So what would be ideal from my perspective is if um, you really do consider the documentation risk, no matter what the credit is, so that the overall market would be
right.
better in terms of documentation standards. That would
So
be
so
my
it,
ideal world.
so it's a tug, it's a back and forth between the commercial interests of the lender and the documentation guys like yourself, right?
Yeah,
Also, Ian, like you've been in this market for a long time, you look at these things, 500 pages of document, oh my God, on each deal. So, uh, you, what is your experience on looking through this? Like, what has changed or needs to change, you think? What are the red flags also? Like, what should we worry about? Because everything seems to be going up all the time. Everyone says buy, buy, buy all the time, and there is no real correction in markets. Like, what is the thing that people should watch out for, you think? What worries you?
yeah, so I sort of alluded to it at the beginning, but I think what's going on in the current market is what my colleague Jessica Reese calls a whack-a-mole approach, right?
Right,
It's that every time there's a new transaction that hits the headlines, the lawyers, well, let's start with us. We at Covenant Review will point out what happened, and I'm guilty of this myself. Let's see PetSmart, let's see Envision. Um, but then we point out the loopholes that were
right,
used to do this transaction, and then the markets gets to drafting the latest blocker to stop this exact transaction from happening again. And then next week, the lawyers look at the new blocker and figures out a way to get around it. And then we have another new transaction, and then and then it's a cycle, right? So it's an endless cycle of um, patching up the documents by trying to address in a
Right.
very focused way the latest transaction. And because, like, as I discussed before, you really need to preserve the flexibility of the company. So you don't want to take like a sledgehammer to this and
Right.
just sort of saying, well, thou shall never do a transaction.
Right.
You know, you should never make an investment. You can't say that. Like, so
Right.
it has to be very narrowly tailored. But then when you're narrowly tailored the provision, it means that there are easy ways to, well, I should say easy, nothing is easy. But there are ways to get around that blocker or loophole.
Right. So your idea is to just highlight it so that people can take action or talk about it or see. It's basically due diligence creation. Yeah, that's what your role is. Yeah.
Well, I think, well, let me talk about it a different way. I think what's going on is that even with these blockers and that are being drafted, what remains is that the company still has a lot of flexibility to
Right.
do incremental debt, to make dividends, and to make investments. So sometimes it is a little bit too generous. I think people need to start looking at that instead of just like focusing on the book. In other words, let's just see how much debt capacity you really need
Right.
to run this business, right? And if you're going to be doing a major acquisition, maybe we should like have a little bit of a say on that. Like if you're going to take on additional leverage beyond this point, maybe we should get a look-see, right?
Right.
Um, and the other thing that happens as well is that all of these provisions that I just mentioned, right? So you could put
Right.
in a blocker that says you can't do another Xerox is the latest headline grabbing transaction. You can't do another Xerox type transaction.
Right.
Guess what? That provision can be amended by a simple majority of lenders,
Right.
right? So, and that simple majority is what it takes to do an LME, right? That lender
Right.
and lender balance. So you could still have an LME, even if there's a blocker that says that you can't do the LME,
Right.
right?
Right.
So
Right.
That's how the lawyers have massive houses. And
yeah,
Yeah. Where
exactly.
they're like, where are all the customers' yachts? That famous. Ian, I would I'm guessing, but I would imagine that AI has become a big part of your workflow or your analysis. Am I wrong, or is that
No, that's absolutely right.
yeah.
Absolutely right. I mean, it's very interesting. So I spoke at a conference like 2 years ago, CLO and technology conference, and my CEO at the time told me that I had to say the following thing, that the AI that you're using today is the worst AI that you will ever use. And I said it, and I told him I said it, but he was absolutely correct, right? Because I just remember like starting out with when we had initially ChatGPT, I sort of like I am like Mr. Fancy Pants, I know everything. I sort of constructed this like elaborate prompt, and like I had like this context window, and I was like, okay, I'm sure I can get this to like work to like extract some like data from some
Right.
complex documents. And it did not work. So I sort of like, okay, this is like not good. As much as they're praising this ChatGPT and all OpenAI and all everything's like not really great. Fast forward to a year after that,
Right.
still wasn't working so good. 2 years after that, still, I mean, and today the technology has this tremendously improved. It's like
Right.
amazing. However, it is not. There are still issues, right? So and we can talk about it a little bit more, but I think the way to think about it is that um, I don't think right now anyone who is in sort of like a knowledge base industry where human judgment is important
Right.
Right.
is in danger of losing their jobs, right?
Right.
And I think even the sort of and I think anyone who's in a business where accuracy is key,
Right.
even for like a repetitive task, that if it needs to be accurate, I think you're not in danger there either.
Right.
Right.
Um, um, because until we get to sort of like artificial general intelligence, the machines still don't have agency. So you still need the sort of like subject matter expert who is teaching the machine or providing
Right.
prompts to and giving the tasks, right? And
Right.
that's like where
Right.
the expertise is right now.
Yeah, I mean, Shanks and I convince each other every day that we're irreplaceable because of our brilliant market insight. So, yeah,
I agree. I agree.
yeah,
Hope my boss is listening. Yeah.
yeah,
Yeah.
Mine too.
So actually, Ian, one of the things I wanted to ask you is like, if there is a finance graduate out there, right? Like, or a law graduate,
Mhm.
how do they get into whatever you are doing, right? Like, this is so specialist. I agree. Like, but nowadays you see a lot of law firms have financial market expertise, right? Like, and
Mhm.
they're building on it. Given how the market seems to have evolved, there is all this documentation tiff going on between everyone and everyone trying to get an edge. Do you, what should they do to get into a field like this? Like, you, just being a lawyer is not enough, right? Like, you need to understand financial markets.
Sure. I mean, let's just take my own example, because I have a very nonlinear career path. My undergrad was in physics.
Oh,
Um,
wow.
yeah. Yeah. Uh, well, I never worked a day as a physicist in my life, so it's like not that impressive. And I do not remember any of those equations, so do not ask me to
yeah, of course.
help you there. But I did physics in undergrad. Then I went to law school. I ended up at a great law firm called Davis Polk.
Right,
I did finance there. I did some knowledge management work there, which is that basically you're curating the intellectual expertise of the firm, and
right,
you're allowing people to access that knowledge, which was a good base for what I'm doing now at Davis. Often review,
right,
because essentially you need to be able to like summarize very difficult either principles and like explain them to people, right? Like, say if you're training a junior lawyer and
right,
you're sort of like explaining a very complicated concept, you need to be able to like figure out what is important in that concept and how to sort of convey it in a sort of like understandable way, which is
right,
basically what we do at Covenant Review for our customers. We summarize these like very difficult,
right,
complex documents, parse out what's important and why, not just saying that this is what's like prevalent in the market, but like explaining why it's problematic to not to have this provision in your document. Um, and so it's, there's like a lot of ways that I got to where I am now. Like it's just
right,
basically putting my hand up when I saw something that was interesting to me that I wanted to work on,
right,
or sort of like not saying no when somebody asked me to do something. So like when I was asked to like develop the middle market service, a contract review, I did that. When I was asked to develop the data feed
right,
for LIBOR SOFR. I did that.
right,
And then now, working on a bunch of different initiatives involving AI, which are just like very interesting. I mean, to me, I just like what everyone else thinks is an intractable problem. I will solve that intractable problem for you. Um, so,
right,
so just like sort of like put a bow on it, it's really, um, there is going to be a lot of room for new graduates, whether in finance or law,
right,
to have a fulfilling career in the finance industry.
right,
I think even with the prospect of AI, like I said before, I
right,
think the, the important thing is to not rely on the AI to teach you how to be a
Right.
lawyer, right?
Right.
Right.
You still need to develop that expertise.
Right.
And whether it's a lawyer or a finance professional. I mean, I know some of my clients have told me that their juniors are just using AI and not checking it. Like,
Right.
stop doing that, juniors. Check, check, check. Um, and so I think, like I said before, we're not going to get replaced. We are still in that area where human judgment is really important,
Right.
and can't replace that at this point in time with AI. Um, Ask me again in 6 months, Shankar. I may have I'm going to have the same answer, actually. It's in 6 months, I'm going to have the same answer. No matter how good the AI gets,
Right.
until it gets to AGI,
Right.
it still needs some agency, right?
Right.
Well,
No.
I mean, I think that your theory will become apparent the next meaningful downturn in the market, right? Where, like in the housing market, housing crash, everybody looks around and says, "Who thought that was a good idea?" Right? Like, where was the guy with the judgment, right? Rather than
Yes, yes.
so. I think that periodically, we need reminders of that. Unfortunately, it only comes when the markets
Right.
deteriorate.
But I think the message broadly is also like, you need to evolve with the times, but you also don't forget your old roots, like basic stuff like reading stuff, and analyzing things on your own, taking up new challenges, exploring new areas. I think it's important, and I guess I'm talking like a really uh, old school guy now.
You're talking
Yes,
your
you
book,
are.
Shanks.
You're showing your age, Shankar.
But thank you very much for this, Ian. We always do this when we have a fantastic discussion. We exceed our times.
Yes.
But thank you very much for that, Ian, and it's a pleasure to have you on this. And thank you for your support. And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts. And tune in next week when we'll get another interesting guest to talk about something else about the credit markets. If you want to receive real-time reports and market data, you can request a free trial of IGM services. The link is in the show notes. Thank you again and have a great weekend. Thank you. Thank you,
Thanks,
Ian.
everybody.
Everyone.
Thank you.
Thank you.